I'm not positive of this, but I think stablecoins, including Tether, may be one of the largest buyers of gold today.
That's perfect. So the people that have been bullish on gold for so long and bearish on crypto and Bitcoin, they're finally getting their big rally in gold, and it's because of the thing they hate so much, crypto and Bitcoin.
Yeah, that's right.
That's so funny.
Tether is proving to be a good meeting ground between Bitcoiners and gold people.
Hello everyone, this is BTC Insight, and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
Tom Lee begins by addressing a central question in every investor's mind. Should we still be bullish on U.S. markets, or has the rally gone too far? His answer is grounded in facts, not emotion. The U.S. remains the global hub of innovation, capital, and productivity. When the world's largest bank, J.P. Morgan Chase, commits $1.5 trillion to invest directly into the American economy, that's not a trivial bet. It's a vote of confidence in U.S. competitiveness in sectors like AI, energy, infrastructure, and digital finance. Lee reminds us that money talks. When the biggest institutions in the world double down on the U.S., it tells you something about where the future is being built.
Really ties into why investors should stay pretty constructive on the U.S. I mean, J.P. Morgan, the biggest and the most powerful bank in the world, is investing $1.5 trillion into the U.S., into things that are going to strengthen sort of U.S. advantages, critically important areas. And at a time when the U.S. is dominating AI, and of course now we have this big tailwind as blockchain is an initiative that Wall Street is building products on. So I think there's a lot of reasons for investors to stay optimistic. And I know there's a lot of talk about bubbles, but I think the thing I would just continue to point out is NVIDIA trades at around 27 times forward earnings. It's still on a PE basis cheaper than Walmart and Costco, which trade at around 47 and 34 times forward earnings.
Yeah, you've got positive reasons to think that earnings are going to do well in a time when interest rates are coming down. So that's just like an elixir for stocks that is very powerful.
That's right. And as you know, CEOs have not been that confident for the last 2.5 years because the Fed's been running tight monetary policy. The ISM's been below 50 for 31 months now. That's the longest stretch in history. I think the sell-off Friday is giving us a bit of a gift because that surge in the VIX, a 32% rise, is the 39th highest ever one-day surge. And the 1-month median return is almost 3% of the 38 other instances. So I think the S&P could add, 200 points between today and mid-November.
Still got, we're not overly positive in terms of sentiment right now, so that's not late cycle according to you at this point. And still a hated rally, $7 trillion on the sidelines if people decide they want to go into stocks.
Yeah, I think conviction is a measure of whether or not the market is, pricing in too much good news. I think with Friday's sell-off, I saw many people calling the top of the markets or declaring that the bubble is bursting, or that, this is the reason to be buying gold. And if investors are that quick to call a top just on a 2.7% decline, I just think a lot of good news isn't really priced in. I think there's still a lot of reluctant investors on the sidelines.
For the past 2.5 years, CEOs have been cautious, even pessimistic, due to the Federal Reserve's tight monetary policy. The ISM Manufacturing Index has been below 50 for 31 straight months, the longest stretch in U.S. history. That means sentiment has been deeply negative for a very long time. And yet, stocks have climbed. Why? Because markets always price in the future, not the present. When Lee looks at market behavior, like the recent Friday sell-off, he sees opportunity, not warning signs. That single-day volatility spike, a 32% surge in the VIX, ranks among the top 40 largest in history.
You have found a kind of everything's about crypto. You found a reason gold's up, and it's because of crypto. Not directly because of crypto, but you think the incremental buyer in gold there's gold-based stable coins, and people need to buy gold to back the stable coins. And that, do you think that's enough to be up $92 all the way up to a new high?
Well, there is an interesting correlation we found, which is when I look at Tether's supply of dollars outstanding, it really started to rise about 3 months ago, and that corresponded with gold essentially going up every day. I'm not positive of this, but I think stablecoins, including Tether, may be one of the largest buyers of gold today.
That's perfect. So the people that have been bullish on gold for so long and bearish on crypto and Bitcoin, they're finally getting their big rally in gold, and it's because of the thing they hate so much, crypto and Bitcoin.
Yeah, that's right.
That's so funny.
Tether is proving to be a good meeting ground between Bitcoiners and gold people.
Tom, can you just explain, though, to the extent we can understand it, within at least the Bitcoin world, just how much leverage there is in that system? Because I think one of the things that we were looking at Friday was the possibility, at least, that some of that selling, or maybe even a lot of that selling, came from margin calls at that time.
Andrew, there's always been a lot of leverage in crypto. I think that the volatility and leverage is what has drawn people into that space, especially when you get outside of Bitcoin and Ethereum. Those two are generally not held on margin. I mean, there is some leverage with what they call perpetuals, but that's why they held up so well over the weekend. But this liquidation that was triggered over the last 3 days, the estimates are at least 19 billion of liquidations, but it's probably understated. It might be 4 times bigger. It's the largest since 2021. Essentially, you have to go back to FTX. I think there is a lot of leverage in the way people use this product called perpetuals, which is trading on margin, like 3x, 20x. And it lurks and it's held through collateral. People like sort of pledging something that thinks it's safe, but when the price of that collateral drops, it triggers a cascade. Right. And so I think people talk about this thing called auto deleveraging. So a lot of leverage, yes.
Of course, no analysis would be complete without addressing the risks. Lee turns to crypto leverage, an often overlooked but crucial dynamic. He explains that while Bitcoin and Ethereum themselves are relatively stable, the broader crypto ecosystem, especially in perpetual futures, is highly leveraged. Traders routinely use 3x to 20x leverage, pledging collateral that can quickly lose value. This structure creates a cascade effect. When prices drop, margin calls are triggered, leading to forced liquidations, which push prices even lower, amplifying volatility.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.